Welcome back to another video. I have a lot to talk about since the last time I posted a video, so I'm just going to dive straight in. And by the way, if you're wondering why I'm not recording myself today, well, it's because I just wanted to get this video out. It's been long enough, so I'm just going to record only my voice today. Now, I'm going to talk about stagflation. And stagflation, by definition, means high inflation and a recession at the same time. And I want to start with something that happened a few weeks ago, and it was a lot in the news.
America is a nation that can be defined in a single word. I was going to put him.
No, I'm just kidding. It was the inversion of the yield curve. Now, let's begin with the question. Maybe you haven't heard of the yield curve at all, or you have no idea what actual F I'm talking about. Sorry for swearing. But let's just start with the basics. Let's begin with the question, what is a yield curve? Or maybe even more basic, what is a yield? When you have a bond or a note, let's say a 1-year treasury with a face value of $1,000, a price of also $1,000, and a 5% coupon payment every year. This means that your yield on this investment is 5%. Now, what if the price of this note drops due to people selling? Because, for example, people expect inflation to be high in the next year. It means that the price goes down to, for example, $950. And if you now buy this note, your yield is not 5%, but it's actually 10.5%, because you still get the same amount of coupon, just for a better price. Now we know what a yield is, we can calculate this number also for bonds, or short-term maturity debt instruments, like T-bills. And if we then plot all these yields of all these debt instruments in one chart, we get the yield curve. Now, normally this curve is upward sloping because people demand a higher yield for payments they get later into the future, since there's simply more uncertainty in the next 20 years than in the next 6 months, right? That makes sense. Now, what has happened recently? Well, the yield curve inverted, meaning that the spread between the 2-year and the 10-year yield went negative. So let's put up a chart here. Here's a chart of this spread, so the 10-year minus the 2-year. And take a closer look. Do you see a pattern? Well, indeed. This inversion of yields has had a really good track record of predicting upcoming recessions. Also with the 2020 recession, because the spread actually went negative in August of 2019, which shows you that there is a lot of consistency for this pattern. Now, another interesting thing is that this negative spread most of the time is only short-lived, and that the spread is positive again when the recession or the crisis hits. At the moment, the spread is positive again, so who knows? We might be closer to a recession than you think. Now, the Federal Reserve, which is the central bank of the United States, they will of course say that this doesn't make sense and this is just a spurious correlation. We should look at the near-term forward spread, which is based on yields from maturities shorter than 2 years, and saying that this has a more transparent interpretation. So basically, the Federal Reserve is telling us here, well, there's nothing to worry about. This is just a spurious correlation. It doesn't predict a recession at all. We should really look at this near-term forward spread. But you have to take this with a grain of salt, right? The Federal Reserve is never going to admit that a recession is coming, because that would create absolute panic in the economy and in the markets, right? So it makes sense if you have a vested interest in not creating a recession. Now, enough about all these yield curves and spreads and whatever. I also want to talk a bit about other factors, apart from these market-based indicators. The past is no guarantee for the future, and the predictions of these inversions do not, of course, have a 100% track record. First of all, GDP numbers. GDP was expected to be lower than they previously expected, not only for the first quarter of 2022, but also for the entire year of 2022. And what did we get? I think it was a week ago. What did we get? We got a negative print for GDP, lower than the lowest expectation of all of these very large, prominent institutions, all getting it wrong, because the true GDP number, the true annualized GDP growth for the first quarter of 2022 was minus 1.4%. So this was a really bad number. It had the largest trade deficit in history, basically, and if you look at a chart of the trade deficit, I mean, every month it's getting more negative and more negative. And you have to realize that the economic effects of the Russia-Ukraine war still haven't fully transmitted itself in these numbers, meaning that along with rising interest rates, there's quite a high chance that the GDP number in the second quarter of 2022 will also be negative. And why is that significant? Well, because that would officially fulfill the definition of a recession, which is 2 subsequent quarters of negative GDP growth. Now, this original definition has been slightly tweaked ever since by the National Bureau of Economic Research, but if you look at their definition, we are still very close to a recession, in my opinion. The second topic I want to talk about is, of course, inflation. It is a topic I talk a lot about on my YouTube channel in a lot of videos, and for people, by the way, thinking that inflation is still transitory, keep dreaming, because it is not only transitory, it's going to get much worse. For example, because of the Omicron variant, there are lockdowns again in the big Chinese cities, like in technology city Shenzhen or in Shanghai. And we know that China is very strict in their policies of combating the virus. So this will undoubtedly have a big effect on the West as well, since China is the biggest exporter of goods in the world, as we all know. Like I've discussed before, the war with Russia and Ukraine is still going on, right? I mean, it's not like this has already passed by and the worst is already over. No, this is still going on. And with all these bans and measures on oil and gas that are already there and those that will still come, it will have a massive impact on inflation, especially in Europe, since they are much more energy reliant on Russian energy than the US, for example. But this also holds for other products like grains, like wheat and cooking oil, which people are really hoarding at the moment with empty shelves everywhere, also where I live. And these shortages are basically due to the fact that these products are mainly produced in Russia and Ukraine, right? These are countries that are often referred to as the breadbasket of Europe. But it's also fear and greed of people, which makes the problem only worse, especially if you read these sort of headlines. But also, don't forget the dovish monetary policy we have. I mean, we have printed trillions of dollars and euros in combination with record low interest rates for years. I mean, this has already been going on for years and years already. And I never hear this in news articles or in columns or in papers that I'm reading. It's always, it's this or it's that, but it's never the fault of the central banks, which of course it is, right? It is their fault for the largest part, in my opinion. And if you look at Europe, interest rates are still negative. I mean, that is just ridiculous. We have, where I live, in the Netherlands, 12% inflation, and we still have such a dovish monetary policy with negative ECB policy rates. It's just ridiculous. But remember, these are government statistics, so in reality, it is of course much higher. And I can talk a lot more about factors why inflation is going even higher, but I will spare you your time. Just know that inflation doesn't only hurt your wallet, but it also hurts the economy. Because it is so interconnected these days due to globalization that inflation is everywhere and in everything. Right? But okay, well, if inflation is going higher, then we can just raise interest rates, right? I mean, it's already going on right now in the US or in Canada or in the UK. But you have to understand that inflation is already so extremely high that 0.25 or 0.5% interest rate hikes are not going to do anything. I mean, inflation will only go much higher because the real interest rate is, for example, in the US, it's like minus 7%. So you are completely running behind the curve as a central bank, not only in the US, but also in Europe. But let's now imagine a scenario where the central banks are able to raise interest rates enough to combat inflation, to the point where real rates are actually positive. So interest rates are above inflation. Well, imagine that. We would be in a complete crisis with the amount of debt and amount of leverage there currently is in the system. Look at all the sorts of debt we currently have. Look at the new highs in household debt. Look at margin debt. Look at corporate debt. Look at the $30 trillion national debt of the US government. But also think about companies that have to refinance their operation. It is an unthinkable scenario in my opinion. We would be in absolute crisis. And by the way, we are already seeing the cracks occurring right now, with the central banks getting less dovish and starting to raise rates. And I actually think that when the economy is going into a recession, with the Federal Reserve still raising interest rates and inflation still very high, I think that the central banks will reverse course and they will do another round of quantitative easing. They will lower interest rates again, fueling the inflation fire even more. And eventually, higher prices and all these malinvestments will harm the economy even more, and we will be in the biggest stagflationary crisis we have ever seen. And the funny thing, or actually not funny at all, but the reality is that inflation is the cause for the upcoming recession, which is unheard of in the central bank dictionary. You see, the only thing the central banks have going for them right now is that unemployment is very low and we have a tight labor market. Now remember, we always have to take the government statistics with a grain of salt, but indeed there is a lot of demand for labor. The problem is not only that a lot of people are not filling those jobs, but especially that this is going to massively change. You see, when all these small but also large businesses that are already struggling financially are going to default, many people will get laid off and unemployment will rise significantly. Let me explain why inflation the central banks and government created themselves for a large part is going to bite them in the butt. When you have extremely high inflation for producers, which is what is going on right now, look for example at producer price index numbers absolutely skyrocketing, especially in Europe, it means that you have much higher input costs, and this especially hurts the agriculture, the industrial, the retail, and the restaurants, and it hurts you, because it's naive to think that a large part of these prices are not incorporated into the prices you will pay. Now, because inflation is so high, central banks are forced to raise interest rates, right? This is what I've discussed before. So interest rates are rising right now, meaning that borrowing money to keep financing the already struggling operations becomes even more expensive. So inflation is the true root of the upcoming recession. And like I've said before, this is stagflation, and it is very difficult to get out of that spiral. And again, it is very likely that the central banks will revert course when the economy goes into recession, meaning either interest rates go down again or they start quantitative easing again, or maybe even both. So in conclusion, inflation will go even higher. And that's why I keep saying almost every video, buy gold, buy silver, buy tangible stuff, and buy stuff right now. Don't hold on to your paper currency. But that's it for today. Let me know what you think about stagflation. Let me know what you think about recession, about the economy, inflation. Doesn't matter. Don't forget to like, comment, or subscribe, and I will see you around. Bye bye.